So in this segment, we're going to be talking about a so-called Brexit benefit, which I don't actually think it is. I could be wrong, but it says title Bank of England seeks to unlock cheaper mortgages with post-Brexit rule change. And the issue is that I haven't seen any evidence that the EU was stopping any of these changes. Because from what I've heard, what I know of the financial industry in the UK normally has higher standards than the minimum EU rules, which makes it one of the kind of more likely places businesses want to set up shop. There's less of a race to the bottom. But I've read through this article, I've read through the subsequent article that they posted, and I couldn't actually find anything to say what this Brexit benefit is. Mogg says the benefits of Brexit keep rolling along, but it's a post-Brexit change, so it doesn't necessarily mean it has anything to do with Brexit. And we're going to try and figure out if that's the case going through this article, because I've read through it. It doesn't look like it, TLDR. The Bank of England is poised to unlock cheaper mortgages for millions of households after pledging to use its post-Brexit freedoms to introduce a more British style of rulemaking. It's possible that the Westminster government has given more control to the Bank of England over this, but I genuinely don't think this has anything to do with the EU, or if the EU actually stopped us from doing this stuff. Seeking to axe overly expensive and onerous rules that make it hard for small banks to offer cheaper home loans, following a legal overhaul that gives the institutions more power to set its own agenda. So obviously these were changes made by the British government. The question is, was this implemented by the EU in the first place? Also, the fact that the UK played a large part in shaping EU laws around the financial industry. So evidently, if this was a thing that became a problem, the UK definitely had a say about it once before it was even implemented. Again, these people don't make sense. The government is abandoning the top-down approach to regulation that was beloved by Brussels, where watchdogs were given a strict set of rules and ought to follow them closely with no room for interpretation. That's not true. All rules have slight ways of interpretation. That doesn't make any sense. The top-down approach of regulation, that is how regulation typically works. So again, really strange statements here. A law currently going through Parliament will give the bank far more power to make changes to the rules without new legislation for every detail. So essentially what they're saying is they're going to give more power over to the regulators, but the problem is when these things go wrong, it makes it far harder to keep people accountable because you've given people a lot of freedom here. Sam Woods, head of the PRA, the Prudential Regulation Authority, a part of the bank which settles rules for the city, said the proposals will enable us to adopt a more British style of rulemaking with less fine detail in legislation. Yes, because British people apparently hate to read and understand things, and more ability for us to maintain and develop a coherent, dynamic rulebook. So again, it's nothing. I can't see anything for this to say, leaving the EU has changed any of this stuff. All it does look like it's giving regulators more say over how things are done. Essentially, the PRA, the Prudential Regulation Authority, they've been given more control over things. That's about it from what I'm reading into this. Mr. Woods expected to use these powers to reduce the amount of capital small banks have to hold on to if they want to offer products such as mortgages. I mean, did we learn nothing from the '08 crash? If these small banks, give riskier mortgages and riskier products, and things go wrong and they don't have the capital to back up these bets, they're going to cap in hand to the government for a bailout. That's what's going to happen. He said, we're already developing a simpler regime for smaller banks, which would be good for both safety and soundness and for competition. I mean, can you do deregulation and claim it's for safety reasons? I don't know. I don't think so. He says, the person says, Mr. Wood says, we call this strong and simple because we have no interest in a weak regime. Did you call it strong and simple because strong and stable was taken? And deregulation doesn't lead to anything being strong. You can lead to things being simpler, sure, but not strong. He said, they say if the planned reforms work, they could lead to a fall in the costs that challenger banks face when issuing mortgages, cutting prices and boosting competition to the benefit of home buyers, which I'm not necessarily against that, having more banks and building societies offer mortgages. I'm happy with that, but they have to be able to back themselves if things go wrong. If there are financial crashes or problems within the economy, they have to be able to bail themselves out. They can't keep relying on the taxpayer, because we saw what happened before when that happened. Ian Gordon, an analyst at Investec said, put simply, is uneconomic for a challenger bank to operate in the standard vanilla mortgages market. And are these changes the government are going to do to, is that going to help anything? Because the points they make here are really stupid, and we're going to go through each one and talk about them. So the only markets where challenger banks or specialist banks can potentially make a sensible living is in higher margin products. So products you make more profit in, which are typically done through riskier kind of bets, really riskier offerings. Whether that be professional buy-to-let, so buy-to-let, which is you buy a house to rent it out essentially, which it's going to help landlords, which I don't like. Or high loan to value. So loan to value is how much the house is worth compared to how much the loan is compared to the value of the house. Say, for example, if a house is worth £100,000, a bank would offer typically 90%. So they would offer you £90,000. Some do go up to 95% loan to value. It depends. And for certain other places, they only offer 85% depending on the property. You've got to look at individual lenders there. But the only way challenger banks make money is by offering more than can they offer more than 95% in loan to value? I don't know, because they did change the rulings around that, I think, during the financial crash. But evidently these banks, these kind of challenger banks are looking to make money, or had to look to make money in these kind of riskier bets, again in higher loan to value, or leading to non-standard or self-employed customers. So non-standard, maybe someone who makes their money in the darker or murkier ways, or maybe someone who makes money through cryptos. Or self-employed customers. Self-employed customers can get loans from banks typically. They just have to show 2 years worth of tax returns. If they have 2 years of decent tax returns, you can typically get a loan from a bank. So again, these challenger banks are looking to make money from riskier bets here. And that's why they want to make the rules easier for them to not have as much capital by the looks of things. But again, I'm not seeing this as a Brexit issue. The current regime forces banks into niche or higher risk products. So this could be a good thing, but again, if things go wrong, which they inevitably will do, will the banks have, these smaller banks, will they have enough money to keep themselves afloat, or are they going to go cap in hand to the taxpayer, just like the bigger banks did back in 2008? Taking on extra responsibilities, the PRA will hire another 100 staff, contributing to the need to raise an extra £24 million from banks and insurers, raising the fees charged by the PRA to 8%, or by 8% to £320 million this year. So they're going to ask a lot more from the banks, and I doubt they'll be very happy, especially the bigger banks, in having to pay more in fees and also having to deal with more competitors. So that should be quite interesting. They talk about in this article about where has it gone? The financial institutions' confidence are on the rise. They did this by drawing on the determination of the British people, blah, 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 blah. Rubbish. All of this is genuinely just rubbish. And again, they call this a Brexit benefit, but they haven't actually spoke about which EU laws stop smaller banks from being able to offer more mortgages and how much capital they have to hold. They haven't actually talked about which EU laws govern over this. I know there's Solvency II, but that exists, I think, just for insurance companies. So I could be wrong on this, but I'm not seeing a Brexit benefit in this story. And Mogg didn't actually elaborate on where the EU were causing issues here, or potential, seen what issues were perceived to be seen. The title is very misleading for someone who won't read the article like Mogg, because it says the Bank of England seeks to unlock cheaper mortgages with post-Brexit rule changes. So after Brexit, so they're making changes after 2020, really, but I don't think this has much to do with Brexit. I might have just wasted everyone's time by covering this and getting you to listen to it, but yeah. Anyways, I'm going to leave it there. Let me know what you think in the comments below. Like, comment, share, subscribe. Support the channel on Patreon if you can. And hopefully I'll see you in the next one.